Have you ever wondered why private equity companies buy companies? And I don't just mean like they invest in a company, but they actually buy the whole company. What's the whole strategy? What's the thought process there? Why does it work? Why do they do it? That's what we're going to talk about today. We're going to talk about what private equity is, why they buy companies, how they make money, and we're going to do it all with a fun example of a little dental office. All right, let's dive in. So, first of all, what is private equity? Well, private equity is on its face just like any equity that's privately held instead of being on a public market. But when most people refer to private equity, what they really mean is leveraged buyout private equity. Or, in other words, private equity funds that go out and they buy entire businesses, usually using debt or leverage to do that. And then they use a number of different levers, including the leverage, to generate really good returns off of businesses that are otherwise fairly boring, to be honest. Most private equity funds don't invest in startups, don't invest in high growth companies. They don't really like risk. What they really like are companies that are cash flowing and generating profits. And I'm going to explain why in this video. Let's dive into how private equity funds make money, and it will become more and more obvious why they actually buy whole companies. So there are a lot of different ways that PE firms make money, but the first one and most important one is leverage. So I thought it would be helpful to use an example of a small business that a private equity fund might buy. Let's pretend that we've got a dental office. Excuse my poor handwriting with our dentist. And this dental office is generating, let's say they generate $4 million in revenue each year. But after they pay for their rent, they pay all of their expenses for all the staff and all the materials and everything else, that leaves them with $1 million in, we're going to call this cash flow. Now, we're going to call it cash flow because it's not quite the same as profits, but because you can use cash flow, it's not quite the same as profits because profits are after taxes. But what we care about is the amount of cash that's available before you pay taxes, because that money can be used to cover interest expense and other things. So what we care about is cash flow. So let's say that our fund comes in and they say, this is an interesting dental office. What if we bought this company for 5 times cash flow, or sometimes cash flow will be called EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Now, depreciation and amortization, these are non-cash expenses. So it's before those because those don't impact your cash. They're there mostly to reduce your tax burden. Interest does impact your cash, as does taxes. And because interest is paid on loans and private equity funds like using leverage, this is an area where we want to get this number before they pay taxes so that we can subtract out any interest that we're paying on our loans before we pay those taxes. And then what's left gets used to pay down principal. But let's say we come in and we're going to buy this company for 5 times EBITDA or cash flow. So that would be, in the industry, we'd call that 5 turns on EBITDA. That means we're going to buy this business for $5 million. Now, if I'm a private equity fund, I don't want to pay $5 million upfront in all cash. What I want to do is I want to borrow the money. So let's say that I'm able to borrow, let's say $3 million. So I put up $2 million of equity. And then I go to my bank investors and I say, hey, I want to borrow $3 million of debt. Now here's the cool thing. Okay, so with $3 million of debt, here's the thing. If this business generates $1 million, it does not grow. It just keeps that steady pace of $1 million every year. Well, I'm going to pay off this debt in roughly 3 years. Now, it's not exactly 3 years because I'm going to have to pay interest on it and other things and other fees and so forth. But I'm going to be pretty close to about 3 to 4 years depending on interest rates and so forth. So if you think about it, in year 1, I'm going to pay $2 million. right? And then fast forward, let's say the end of year 4, I then go and sell the business. Well, at this point, let's say I sell the business for exactly what I paid for it, which is $5 million. But at this point, I've now paid off the debt every year. So I'm going to get my $2 million back of the equity I put in, but I own the whole business now. And so I pay because I've paid off all of the debt. So I get that plus I get the $3 million. So I get $5 million, but I only spent $2 million. So what that means is 5 divided by 2, I've generated a really nice 2.5x on my investment. Let's say you just invested in the company instead of buying the whole thing. Well, in that case, like if you put in the $2 million and the company still retained the other $3 million, this company didn't grow at all during that time period. They didn't even grow in valuation. You bought it for $5 million or you invested at a $5 million valuation and you sold it at a $5 million valuation. And so you would have just gotten your money back of that $2 million. It's only when you buy the whole thing and you use debt and leverage to buy it that you're going to ultimately benefit. Now, you could argue that like, hey, as an equity owner, I should get my portion of the profits. So let's model what that looks like. So I put $2 million in, and then each year for 4 years, I'm going to get, let's see, 40%. So for each year, I would get 40%, or in other words, $400,000 for each year. So, times, we'll call it 4 years. So that's $1.6 million. My total return in that case, my profits would be 1.6 over 2 million, which is a lot less than 5 over 2. So that is the beauty of debt and why private equity firms like buying these businesses. So that's not the only way that private equity funds make money. The other thing that they'll do is what's called a platform and roll-up strategy. So they will identify a really great business that they think could be an interesting platform upon which they are going to build. So let's say that an investor says, I think this dental office is a great platform buy. The dentist is really good. It's a really strong brand. They've really figured out operations. They've figured out marketing. Like, they're doing a lot of really good things here. I think we could take a lot of this know-how that they've built into the business. I think we could replicate a lot of it, not by launching new dental offices, but by acquiring existing ones that already have a client base, already have, all of that fixed cost already sunk into the ground. I think we could buy those for cheap and move really fast and thereby build a much, much bigger business. So let's say we've got like all of these smaller dental businesses that are out there. So I go in and I buy this company for 5x my EBITDA. So I've now bought this for $5 million. And let's say these smaller dental offices, they're just not quite as good. And maybe they're generating like, I don't know, $500,000. So $500K. Well, here's the thing. When you have a business that's smaller, and maybe it isn't as capital efficient or doesn't have as strong margins, and maybe it's not growing, or maybe it's even shrinking, you oftentimes can buy them for a lot less. And this is called like multiples arbitrage and or multiples expansion. So in this case, I'm willing to pay 5x for EBITDA for this business because I think it's a really strong business. These, I might only be willing to pay 3x. So in that case, I'm picking these things up for $1.5 million. But the benefit that I have is that I'm bolting them onto a business that's not getting valued at 3x, it's getting valued at 5x. So this adds an additional $4.5 million of cash flows or EBITDA to the business. So now I can add that in. Now I've got a business that's generating $9.5 million and it's got multiple offices. And so it's a little less risky, right? It's a little more diversified. If one office doesn't do as well one month, maybe the other office picks it up if they have a great month, versus being solely dependent on one office. Maybe your dentist gets sick in your core office or one of these satellite ones, and all of a sudden, you didn't generate revenue for a couple of weeks while they were recovering. you can offset it with some of these others. So it's a much stronger business from a diversification standpoint. It's also a much bigger business, right? So that means I've spent an additional $4.5 million on these businesses, and I'm generating an additional $1.5 million in free cash flows. Well, in that case, I buy these businesses for $4.5 million, and I'm generating $1.5 million in additional cash flow. So I have my original $1 million, right? Plus the additional $1.5 million, that's going to give me a total of $2.5 million. If I take this same valuation and I apply just the 5x valuation to it that I had before, that's going to give me a $12.5 million valuation. If I paid all equity for this and I didn't borrow anything, then I will have spent $9.5 million, and the company will be worth $12.5 million, giving me a profit of $3 million. But here's the thing. I've now got a business that's generating more than twice as much revenue. So what happens if I go to the next investors and I say, hey, look, this is a much stronger business. It's diversified, it's generating more cash flow, it's bigger. I've proven out that it's a great platform. Like, I think there's opportunity to add 3 more satellite dental businesses onto this. So I think this thing is not worth 5x. I think this thing is worth 6x, which is a totally reasonable thing to say, right? Like, you've de-risked this business. This is a much stronger, healthier business at this point. So now you're not talking about $12.5 million and $3 million in profit. Now you're talking about $15 million. And on a cost of 9.5, well, that's going to give you $5.5 million in profit on 9.5. That's pretty good. Now, in that case, you're sitting at roughly 1.5x. That's not bad, but it's really not like something to get super excited about. But here's where it gets really fun is let's go back and add in the leverage. So in that case where we're actually also using leverage, you have to remember, I'm not just putting up $9.5 million in equity. I'm doing it as a combination of debt and equity. So let's go through and assume that on our $5 million deal, I put in $2 million of equity on that first deal. And then I borrowed $3 million in debt. And then I went and bought these other ones. And maybe I didn't get as good of terms on these other ones because, let's be honest, they're a little more risky. They're a little smaller. Maybe the banks don't want to give me quite as much leverage on them. That's fine. Let's say that on my other deals, I had to put up $3 million in equity, which is kind of a lot. And then I was able to borrow $1.5 million in debt. So as it stands, I will have spent $5 million in equity, and I will have borrowed $4.5 million in debt. Well, here's what I can do now that I've got this combined entity. I go back to the banks and I'm like, hey, I'm no longer borrowing for these individual companies. I'm borrowing on this total platform. So once I'm borrowing on this total platform, we can go back through and we can renegotiate terms. And maybe we get an even better deal than we had before, where in this case, we were getting 60% leverage. What happens if we bump it up a little bit more and we are getting even better leverage? Let's say in this case, we go back to the banks and we say, okay, but now I've got a business that's generating 1.5 plus 1 million. So I'm generating $2.5 million in cash flow every year. How about a loan that lets me pay that off in 3 years, like our original agreement on our platform investment? Well, that means if I'm generating $2.5 million in cash flow and they're willing to finance that 3 times, 3 turns or over 3 years, right? Then I can borrow $7.5 million. What I'm going to do then is I'm going to borrow that $7.5 million. I'm going to pay off the $4.5 million. That's going to leave me with $3 million of additional cash I didn't have before. That gets dividended out. And then if you think about it, this whole company is probably worth about $15 million in total. So at a $15 million valuation, I've borrowed $7.5 million of it. So this is total enterprise value of the company. This is how much money I owe. That then means I still retain $7.5 million in equity, and I've already dividended out $3 million. So what's cool about this then is if I then just go and I sell it to somebody else, and I sell it at that 16x, well, I'm going to get the $15 million back. I'll use $7.5 million of that to pay down the debt. That will leave me with $7.5 million in cash, plus I already pulled out $3 million. So right now I'm sitting at $11.5 million total return on a total investment of equity, right back up to here and here, right? That's that $5 million. So now this gives me, on $5 million invested of equity, that's going to give me a profit of $6.5 million, which represents a 2.3x return on businesses where we didn't actually do anything to the actual business. We just used leverage and scale and to grow our returns. And you can see how, like, using multiple expansion and multiple arbitrage and leverage, you're able to generate a great return. Imagine how much better we could do if I said, okay, now that I've got 4 dental offices, I want to go back to our suppliers and I want to renegotiate, because now I've got more purchasing power. I'm not going to pay as much for those toothbrushes and toothpaste that I hand out and everything else that goes into it, right? And so maybe I can lower my costs and improve my margins. And all of a sudden my cash flow doesn't just go from an additional 1.5 million plus my original million, but maybe I'm able to improve it from 2.5 million to like 3 million. And in that case, all these numbers just get even better. Anyways, hopefully this math helps you understand how private equity investors make money. The important thing here is that if you don't own the business, it becomes really hard to do all of these things, right? You want to own the platform so that you can then go out and buy other businesses and bolt them on and make the thing bigger. And then you want the ability to negotiate how much the business is borrowing and to whom dividends are paid out to. Because you don't want those dividends going out to the original owner. Like, you want to own the thing and you want to take, those additional dividends for all this work you've been doing to financially engineer the entire investment. Anyways, if you want to learn more about private equity funds and how they're structured and why they operate the way they do, check out my other video where I talk about why private equity funds are structured as limited partnerships.